how does the strategy work? Well, we're trading a trend reversal strategy, obviously, right? So as we're trading a trend reversal strategy, we're trading a range, and in that range we have we're bouncing up and down. So when does it not work? It does not work when we break out of that range or below the range. And in that situation, what we want to do ideally is we want to wait till the next range establishes. And our ability to highlight these situations where we break out of a range and go into the next range is directly proportionate to how much profit we make from trading a trend reversal strategy, in this example, the scalper. So how do we do that? Well, when does our strategy work? It works when we're bouncing around in a range. When does it not work? It doesn't work when we break out of a range and continue the move either higher or lower. And in that situation, usually, unless we, for some reason trigger a long and just stay in that long, that triggers a stop loss. So, probably did here, like here, for example, right? So here's what we're going to do. When based on the scalper, we can estimate correctly when we are in a range and where we're not. When we're not in a range, or like when we're breaking out of the range, we hit a stop loss, right? Which is a clear invalidation of our strategy. So in that situation, we just don't trade. That strategy stops trading until we're back in a range. How do we make sure that we're back in a range? Well, we're trading stochastics. And what happens when we go to the top of the range and we break further out? Well, the stochastic gets caught at the top or the bottom of the range on the stochastic itself. Why? Because it's already at the top and the price is going higher and there's nowhere else to go, so it just gets stuck. Right? So whenever we see the stochastic stuck at the top or bottom, that means that the stochastic is invalidated because the price continues moving higher, whereas the stochastic has no more room to go higher. So if that happens and we hit a stop loss, then we wait. And we wait until we get the first opposite trade. Because here, for example, right, we break out, we hit a stop loss, and then the only thing that can happen here, based on our strategies, right, is that we can only short. We can short, but never long because the stochastic is topped out. So by the time the stochastic bottoms back down, we can say, okay, well, we topped out, and now the stochastic moved further down, moved back down into oversold, which means that we have established a new range. Because that move already happened, and now we're retracted down, and now our next trade is a long. And that's the case for two reasons. Reason number one is we have just reset a range, right? Reason number two is if there is a continuation to the upside, we're in a long, right? And then once that long exits and we're back at the top, we just trade it normally like we usually did. And this rule by itself will also improve the performance overall of the scalper. So number one, you can stay longer within trades. And this is when you already understand what's going on with the scalper, how the scalper is working, right? That's number one. And then number two, so at first, just use the signals as they are. The only thing, when you hit a stop loss, don't trade until there's an opposite trade. And once you get a better and better feeling with the scalper, you can see, okay, well, the stochastics on the higher time frames are still aligned, still going down, so I don't have to exit my short now. I can wait a little bit longer till, say, the 3 or 5 or 15 bottom out, depending on the move. And this goes back into our standard theory of how a range works, right? And this is one important thing to understand, and this is something that we've covered yesterday as well, is that the best way to avoid some obvious mistakes that, if you look into your trading career and trading history, I guarantee you there's going to be some stupid mistakes. And stupid not because you lacked intelligence, that's not the case at all. And if you look back, you might even think, how did I ever let that happen? But when you're in the moment, it's very, very easy to make those mistakes. Why? Because the market is literally trying to emotionally trigger you in order to do those things. by price movement, by the speed of the price movement, and everything else around it that just simulates a casino. So how do we make sure that we will not, fall into that and get emotionally triggered to do mistakes? Well, we do that by understanding and realizing that that's the case in the first place. And because we do that, we will naturally keep it in the back of our heads, and our decision making will be completely different. The main problem is that people don't even know in the first place that that is how the market works. When you do, you'll be, and you know that, you tend to be emotionally triggered. You can set up mental boundaries so that doesn't happen. And what's the result of that? The result of that is, well, a more boring experience in trading, which is exactly what you want. The best thing that could ever happen to you is to make $100,000 a month every single month, and it's boring. Boring means that there's no variability in it. It's very, very, you can expect it every single month what's going to happen. That's boring. And that is exactly what you want, right? And many times it happens that, you get that. That's actually not that hard to attain. You get consistent results. But not because of the market, not because of the strategy, but because of, an internal conflict or some emotional challenge that you have internally, you will make sure to sabotage the trade or the strategy or something like that. An example: you're trading a range, right? Trend reversal strategy. You're shorting, and as you see the price coming to your take profit level, you see it happen fast, and you get all excited. And what you do is you take the take profit levels that were there correctly, and you remove them, and you put them somewhere into Neverland here. And what's going to happen is that the price will hit exactly the levels that you previously put the take profits to, but you're not going to take any profits because you removed them, and the price is going to reverse against you. You're going to be negative and either not have profits, or you're just going to be negative. Or, there's also a situation where people blow their accounts that way. And a loss like that is going to hurt you, right? And because that loss hurt, you're just going to over-risk the next trade and over-leverage the next trade. And what's going to happen next is that, you're revenge trading, and you're risking more, and you're losing more. And then, faster than you can even realize, you blew your account. And this is not something that's special or extraordinary. This is the default. This is literally what happens to most people. When you talk to traders that, have been trading for at least a year, like, most of those traders blew their accounts at some point. I blew an account before, right? Alex blew an account before, but most people do, right? And the most important thing is to understand why it happened, how it happened, and to never do that again. And it is logically, in a step-by-step basis. It's not something that's hard to do. It's not rocket science. The issue comes in when emotions, start taking over, and then a very, very rational and logical procedure becomes all cloudy and messed up. And that's, in that cloud is where most people operate when trading. That's where 99% of people operate when trading. And at that point, when you're in that cloud, it's not trading. The definition of trading is nothing, it has nothing to do with, trading in a cloud based on emotions. That's gambling. That's all it is, gambling. If you want to trade, meaning that that's how I classify trading, right? That's how we classify trading here, is by saying that trading means that you can expect on a consistent basis to take out profit out of the markets every single month, or depending on the time frame that you work with, right? It can be every month, every quarter, every year, every decade, whatever. But the point is consistency, right? And consistency also, when you look at investors, that's the main thing people look at. Yes, profitability is one thing. However, if you're not consistent, the profitability does not make any sense at all. Because if you move your account by 50% a day, well, that's great. You can increase 100 grand to 150 grand within a day, but then the next day you're back on 75, and then the next day you're back on, zero essentially. So this is an important thing, and the way we fix that is by understanding that that's happening. I know Zebra in the Discord, I think today or something like that, had a bad trade, had a loss or something like that, and this happens to everyone, right? That's nothing to be ashamed of. The important thing is to learn from it. Why did it happen? Why did we have a loss? Because there's two different losses that you can have. Loss number one is based on a strategy, according to the strategy, that is 100% expected within the strategy and just part of it. That's loss number one. And that's completely fine. We want those losses because that just means that we're going according to the strategy. If my strategy says that 80% of the time I win, on average I get 20% in a trade, but when I hit a stop loss, I lose 30%. Well, then that's what it is, right? 80% of the time, I'll make 20%, and 20% of the time, I lose 30%. That's all right. You're still profitable. That's all right. So whenever you have a loss and it's 30%, and this, by the way, those numbers are very, very high, like you should not, over risk that much, but just for simplicity of numbers. And so next time you have a 30% loss, perfect. You're going according to the strategy. You manage that loss very well because it's 30%, which is your average loss, which is exactly what you should expect. What happens often is, people have 8 trades in a row and they're winning and they think they're unstoppable. And then that loss happens, the 30% loss, which, by the way, part of the strategy. And instead of not doing anything and just continuing with the strategy, they take that loss personally and now try to make it back within the next trade plus some profit on top of that, and that's where the vicious cycle happens. That's the decision. That's the one key moment. That's the inflection point where things will start going bad. And you need practice in order to not have that inflection point. And this is the golden rule in trading, right? Assuming that you have your 3 pillars built out for consistency. That is strategy, you have the correct strategy. Risk management, you know how to manage risks. And mindset, you understand, what mindset you should be in, the fact that emotions, tends to be triggered in a market, all of these things. Once you have that basic knowledge, all you have to do, other than trading your strategy, is nothing. The answer to any happening in the market, any reaction from you, your reaction should be nothing. No reaction at all. You have your strategy in place, you trade that strategy. It doesn't matter if, the price moves against you or with you, one candle by one candle or, a huge candle happens. It does not matter. It's all part of the strategy. As long as you follow the strategy, you're fine. That's assuming your strategy is solid and robust. That's a whole different thing. We have robust strategies in the Discord, so feel free to use those. However, once you get into a situation, once you had a loss according to the strategy, your emotional management should be nothing. Don't do anything, just continue trading the same way. When you have a trade set up and it's profitable and you're hitting your, the price is flying towards you to take profits, what you do in that moment is nothing. Don't do anything. You did the work beforehand, now you just let it play out. You did the work beforehand, you have your stop loss in place, you have your take profits in place. Worst case scenario, you know exactly what's going to happen because you manage your risk, you secure your risk and your profits. So nothing horrible can happen as long as you set up the trade the way you're supposed to. After that, you do nothing. What I actually like to do a lot is set up trades, especially range trades. And I have done that multiple times over. Or for example here, let's say I'm trading this range and I see the price go in, let's say we're here time-wise, and I see the price topping out, I see the stochastic topping out, I see the price going towards the top of the range. What I would do is just set up some sell orders at around this area, set up my TP orders lower, and leave. Literally not look at it. Because I know worst case scenario, I have my stop losses, I have everything in place. So in that situation, I don't do anything, and I would come back a couple hours later and I would see, oh, okay, and I would have hit my TP levels. If I was here, I'd be looking at this chart and I'd be like, oh, okay, so we were going towards the middle, and then we started turning back around. At this point, I might have, done something stupid, exited or whatever, or added in more and over-risked or something like that. I wasn't around for this, so nothing happened, and I hit my take profits at the bottom of the range, and I come back for profit. And this happens because we put in the work up front. We make sure that every scenario is taken care of, and then in the execution part, your only job is just to put the orders into the computer. That's all you need to do, because the work has been done beforehand. At this point, you're just executing, right? And that's why, bots and algorithms and automations work well, because that part, that insecurity, is the person going to do what the person absolutely knows they're supposed to do. That question is gone, because the bot is just going to execute exactly what we're supposed to execute. The other thing is, people are not, it's not that easy to define a bot in a way where it's going to, trade in a non-overfitted way, right? So you can't just give it one specific scenario. The rules need to be generalized enough so your strategy actually works, and that goes back to being able to express or write down your strategy in an actual general way, not just by examples, and that's a whole different thing. But the main part is that once you have that work done, all you do now is execute on the work that you've done previously. And while you execute, what you need to do is you need to be aware of the traps that are there for you, which is emotional triggers that will completely cloud your judgment. And then, after you do some actions based on emotional triggers, you look back and you're like, I do not understand why I would ever do this. And you wouldn't, in a logical sense, you wouldn't. But when emotions get involved, that's when the problems happen. And when you look at institutional traders, they're very information driven, right? You can have traders that trade based on intuition, but all that intuition is just a large amount of data that's not being able to be processed by the conscious mind, so it's processed based on the subconscious mind. But they're not trading based on a feeling. They're trading based on conviction, and that's a whole different thing. And traders that trade based on intuition might have a good, really just a talent on how to trade, or how to spot trades, how to spot exits possibly too. But if there's no learned management, risk management, mindset, all of these things, then they will mess it up as well. Probably the best trader based on intuition, in my opinion, is Alex knows him. It's one of our investors. He was on Wall Street for 50 years. He's, 70, 80 years old right now, living in New York. We've been there for 2 or 3 months working with him, on site in New York. And he's a really, really good intuition trader. And like, me, I'm a logical trader. I trade off of probabilities, right? And I always try to get as much information out of him as possible. But he always said, like, it just feels that way. I just think that that's gonna happen. And fast forward a couple hours, it happened exactly to the cent. Now, yeah, I mean, it did help that, he took over coins, like we're talking about crypto and, some small cap coins, he took over completely, meaning that he knew exactly the exact cent the numbers will go to, the price will go to, because he'll just start buying or stop selling or whatever. But also just based on intuition, he was able to hit the right market, hit the right coins within the market, and then hit the right numbers based on that. But you would say like, okay, well, he's trading based on feeling, so I can do that too. That's a 70-year-old guy that has been on Wall Street for 50 years. You do not compare to that person, right? So you need 50 years of experience to be able to have a quote-unquote feeling, right? So, well, guess what? Sorry to break it to you, but your feeling, especially if you haven't traded for more than 10 years, does not have that much of a value unless it's fully backed based on data. And if you're trading based on feeling rather than set core market fundamentals and strategies that you've worked on before, well, then you're in for a very bad surprise. And most people are like, I have seen so many people go into the market and trading based on feeling, which is something that is absolutely inconceivable, because strip away all the colors, strip away all the animations, all this is numbers. So how are you trading based on feeling when all this is numbers, right? The way we trade is, okay, well, we have price, we have indicators, we have core market principles. Core market principle is, for example, like I know I use the range trading example a lot. It's not the only strategies that we have, but it's something that we use a lot, and it's something that works well, and it's by default has a lot of advantages. So when we're trading a range, trend reversal strategy, by default, we're going to be right more often than not, because in ranges the price tends to bounce. We have that. Then we have our stochastics and our indicators that will give us a good indication of, okay, are we at the top of the range, bottom of the range? How far are we from the average? What is that saying? Then we look at different time frames, and we look at alignments of the stochastics on different time frames. Are they saying the same thing? Are they not? If they are saying the same thing, and the price, all of those are confirmed, then the probability of the price going your way is 80% or higher. Like close to 90%, literally, if you have a good alignment. So in that situation, if you are able, based on data, to pinpoint a situation where to 90% certainty the price is going to go where you think it's going to go, then you just trade that. You just trade it. With a 1-to-1 risk to reward, you would be absolutely fine. But we're not with a 1-to-1 risk to reward. What we do is we get better deals because we can anticipate where the price is going to go because we're range trading. So our 1-to-1 risk to reward on average is a 3-to-1, 4-to-1, 5-to-1 risk to reward. Meaning that for the amount that we risk, we get multiples out of it, and we get a larger area that we can trade with. So that's a double leverage that we have on top of our leverage in the first place. And that 90% probability and a very, very high risk-to-reward ratio, so very good deals, that together is a highly profitable strategy. And now we've built a cushion for us that when we execute it, we're able to make some mistakes, because you're not going to be perfect like a bot, and the bot itself will not be perfect either. So you need a cushion in order to be consistent and be profitable. When you have a strategy that's just about profitable on a backtest, good luck. The investor from New York, let's just call him Mark. So Mark would always, any backtest that we sent him, he would reduce the profitability by 50%. He would cut it in half. Before even looking at it, he would cut it in half right away. And that makes sense because you don't account for human mistake, human error. Even a bot can have mistakes, and outside scenarios that we haven't backtested. Even though at that point I wouldn't have done that, wouldn't have cut the performance by 50% because we accounted for so many things. But still, he did that right away, no matter what. So if you have a strategy that's just about profitable on a backtest and you're trying to trade it live, it's probably not going to go well. So that's why we do it this way. We have a very high hit rate and a very high risk to reward. So on the backtest, the strategy is insane. But what this allows us to do is to trade it and allow for human mistakes and still have a highly profitable strategy. So you always need to overshoot it on your backtest. You always need to add in extra profits in your backtest, because when live trading, the performance tends to be lower. So that's something important. And then, when you actually want your actual performance, well, then you just have live trading and live trading performance, right? And you get that by literally live trading. So like months ago, we were talking about backtesting our strategies, and I think it's actually part of the 5-day challenge that we did in the Discord. It's still a playlist on YouTube, so you can check that out. I would highly recommend you to do that because it's mainly focused on, number one, the core market fundamentals, and then number two, on building your strategy based on that. And in there, we're also backtesting a strategy. And I know for a fact, the thing was, we were supposed to backtest 20 trades on a strategy. And the thing was that I told you, when you do that and when you backtest the 20 trades, you will be a different trader just based off of that, because you will see so many things that you haven't seen before. And multiple people DM'd me afterwards, telling me oh my God, this is insane how much I'm looking at the market differently right now just because of that backtest. And that was backtesting your strategy on historical data. What we were talking about a couple days ago was tracking your trades and looking at your performance as always as a basket of 20 trades, and looking at that performance and looking at those trades of live trading data, right? So now that data has full validity to how the performance is, because number one, it is enough trades. It could be more, yes, but just to start, it's fine. It's enough trades to have some statistical relevance, and also it's enough trades to see your gradient, performance, and see, are you improving, are you not improving, what is your volatility. And that is a very, very important thing to do, to understand your volatility, how volatile you are. If you are consistent, if you're even just slightly consistent on live trading data, if you're just slightly consistent, but your volatility on your account is very low, that's investable. That's investable, And all of these, these calls and this information right now, the point of that is to train you so you can pass one of the prop firm challenges that we have in the Discord, because that is based on consistency. And once you do, well, that is just, proof that you're able to trade consistently, and then you get instantly rewarded with being able to trade with, 6 figures. So that's the point. And this is not just here. If you're just trading, you need to keep your consistency and volatility in check, because if it's not, then it is just a guessing game, and it is gambling. And it is gambling because if you take, yes, you can get lucky, but is it replicable? And that's the important part. That's the important part to me, because if I let's say someone comes here and they made $1 million because they just just bought some altcoins or something like that. That's amazing, right? But can you take that, and put that over 1,000 trades? Do they keep up the performance? No, they won't, because that was a one-time thing, right? So as an investor, what you're investing in is the probability and capability of that strategy, person, bot, whatever it is, on generating profits in the future. If your profits in the past were based on chance or based on luck, then that is not investable, because that has no validity whatsoever into predicting the future. If someone comes in with 100 live trades over the past 6 months, and on average they were growing the account by 1% a day, and their account is super consistent and doesn't move at all, and they barely have any losing days, and the losing days are consistent, meaning that they never lose more than 1% or 2%. Well, that's a very, very consistent account, and that is immediately investable. And in a way, to try to find that an account that has at least the possibility of looking like that, that's what the challenges are for, by the way, as well, is to be like, okay, over a period of time, over a period of trades, can you stay consistent? And once again, the consistency aspect is not rocket science. It's number one, understanding why you would or would not be consistent, and then number two, executing on the knowledge that you've had before. So keeping in the back of your mind that your strategy is something that you need to, hold on to and trade only that, and that while you do that, the market will try to distract you and trigger emotional reactions in you that will make you do something that's absolutely illogical to do, which everyone agrees on, and immediately after the trade happens, immediately everything that you did wrong, but you still did it, And the thing is that, well, that's the default. That is what most people struggle with. That is what 99% of people, we call them retail traders, that's how they trade. And that's why they will never be consistently profitable over the long term, because even if they had a good trade, they will have 20 trades like this, where they would explain it to them, like to themselves, like, oh, like this just happened because I did not, or like I removed the take profits and I'm not going to do that again. And then guess what? They do it again on the third trade. And between the first and third trade, they did two other things that were completely stupid in the first place. And it's not because they're stupid, right? That's not the case at all. It's literally the market forcing them to think emotionally. So how do we fix that? Number one, we get repetition and experience and get the strategy into our muscle memory. How do we do that? We backtest and we live trade, or like we backtest. We use the replay function on TradingView, for example, and we backtest the strategy, and we literally go candle by candle as we did when we're live trading. And guess what? Whoever's willing to put in that work, most people don't. So if you just put in that work and you backtest 20 trades, you will instantly skyrocket in the ranking of traders, and you'll be above, the vast majority of traders in the market trading the same thing as you immediately. So that's a very easy thing to do to become instantly a better trader, to backtest and get it into your muscle memory, because then when you see how the candles actually form on a replay, well, then you're able to be like, oh, okay, if I was live trading this right now, then a move like this would probably scare me quite a bit if I'm short or long. So in that situation, I can see how it played out, but I can remember, okay, this situation happened in live trading, and it might have scared me, but now I know that this is just part of trading, part of the price action, and it's there for this very specific reason to scare me. And after understanding that, now when you're live trading, you have gone through that experience in the backtest, on historical data, rather than having to go through it live and risk your account. And guess what? With that approach, you will lose it for sure. So, number one is understanding the strategies or the core market principles by themselves, because that's where we derive our strategies and our decision making in the first place. It's not off of some crazy theories what happens in the market. It needs to derive from core market principles. Range trading. You have range trading, meaning that a price is oscillating between two ranges or two levels. You have that on any market in the entire world, whether that's eggs or gold or Bitcoin or housing or the price of light bulbs. It's the same thing. So you have range trades, and by default, when there's a range, you assume the price to go up, down, ranging within that range, and you will be right more often than not. You will be right all the time until you're not, until the range breaks, right? And when the range breaks, that is something that we need to expect. For example, with the scalper, the first thing that I said about it is, when does it work, when does it not work? And these two questions are something that you should be able to answer in the middle of your sleep about your strategy. When does it work, when does it not work? Those are the two most important questions, and expensive questions too, if you don't know them, that you can have. Because that's the default, and there, just by default, you can understand, okay, can I trade this right now? Cannot trade this right now? Or am I going into a situation where the strategy is going to work or is not going to work? Scalper, for example, right? It works well in ranges. It does not work well when we move between ranges. How do we fix that, or how do we account for that? Well, it trades in ranges. If it does not trade in a range and it breaks out, then that's when it hits a stop loss. So when we hit a stop loss, we stop trading and we wait until the stochastic resets, and just after the stochastic resets, we start trading on the opposite trade. That solution means that, okay, we can trigger, or we can pinpoint a situation where the strategy is not working well, and then wait until we're back in a range, until we're established, and that's when we can trade it again. And in many strategies, those strategies would be great. They would be highly profitable strategies, but they're not, because the person creating it does not understand when it does work and when it doesn't work, and does not filter out trades, or does not adjust or at least account for the fact that the strategy has losing periods. Every single strategy has losing periods, and every single strategy will do very, very poorly at some point. And that's a core market principle as well, because the market's literally designed to change environments for this specific reason. And if you're just trading, and if you have a normal strategy, even if you're making profits, at some point you will eradicate the profits and then some more, if you don't account for the fact that the environment is constantly changing. That's why we created our dashboards in the first place, because that's literally something that's why the bundles are there in the first place, because we have strategies, and yes, we understand when they work and when they don't work, but for example here, this is on a 5 minute, right? If you scale this up to a 4 hour, 6 hour, 12 hour, then this period where we wouldn't trade, which in this case it would be 4 hours on a 5 minute, right? If you scale this up, that would be days or months on a larger time frame. So what we do is, first of all, we filter out the trades, But then we combine strategies together. We combine our trend reversal strategy with a trend following strategy that does make money specifically here. Whereas our trend reversal strategy does not trade specifically here, because that's when it would be losing money. And the result of that is that we have strategies that are negatively correlated, meaning they're trading against each other. And we have, for example, here we have 5 strategies doing that exact thing. And the result of that is consistently profitable results over multiple years. And we have this index, this QC index. We made a new account on Binance that's trading these strategies that started with $100, and it's just going to trade without any intervention for years now. And people that have the signals on Telegram for the dashboards and the strategies will see that account grow with live trades. And with live trades, it will tell you the signal price, the signal time, and then the actual entry price, the actual fill price, all of those details, and every single message, and the growth and the volatility and the consistency, all of that. It's, we have our signals, and our reporting has all that data because we needed it. And it's trading literally this. This is based on data, on previous data, but now we're trading this on top of that for a live account for the QC index. And then the index itself will become an index, meaning that if you want to invest into these strategies, you can just buy into the index the same way as you do into the S&P 500. So yeah, that's essentially everything that I want to cover today, and really bringing the point home that understanding that emotional triggers are something that will constantly try and change our behavior in the market is how institutional traders are able to consistently make profits out of the market, and is also how retail traders manage to consistently lose in the market. And it's not just consistently losing. How it looks like is you have a big win and a bunch of small losses, or you have a bunch of small wins and then a huge loss, and you might think to yourself that you're winning and that you're profitable, but when you look at the P&L, you're actually not. All those things, those are not like some specific things that happen to you. No, it's the default. All retail traders have the same experience, which is this. So how do we make sure that that doesn't happen to us? We understand that that's the case in the first place. We understand how the market works. We build strategies based on the fundamentals on the market, and then we execute on the strategies exactly as we're supposed to. When we're close to an emotional trigger, or something bad happened, our reaction is nothing. We just continue with the strategy. And if that, once you do that, you will get into a compounding effect, and you will grow very, very quickly. On top of that, the interesting part is that when you stop thinking about instant profits, but rather think about consistently, ironically, by being able to trading consistently, money will just flow into you. You'll be able to pass a challenge, you'll be able to trade with a couple of $100,000 right away. And on top of that, many investors will be interested, which, by the way, there's a lot of investors around, also in this community, that are just waiting for, consistent results. So, yeah, that's all I wanted to cover today. If you guys have any questions, let me know. This time it was recorded, hopefully, in the Discord, and it's going to be on YouTube as well. So if you guys don't have any questions, I will talk to you in the Discord. If you do, just DM me or ask anywhere on any channel. People will be able to help you out. If you watch this on YouTube, make sure to like, subscribe, and join the Discord for all the indicators, strategies, and everything that we're covering on YouTube as well. All right, guys, that was everything from me, and I'll see you guys in the Discord.